So we've talked about a quantum walk model of asset price changes and a quantum model of supply and demand. So let's put them together into a quantum model of financial option pricing. So the traditional way of modeling option prices is something like the Black-Scholes model, which assumes that market prices obey the stochastic differential equation. Like this one here, which involves a drift term and a volatility term, and solving it gives this equation, which again is a drift term plus a volatility term. And the discrete version of this equation yields the classical binomial model, which exists in different versions. And the usual one, the steps up and down in log price, are given by these formulae, which we can interpret as a random walk, again with a combination of a drift term and a random walk term. And this R here is going to be our risk-free interest rate. So now let's consider a European-style call option with strike price K, and then after n time steps, the expected value of the payoff is just the positive value of the difference between the price and the strike price, where the exponential is required because the strike price is the stock price is logarithmic. And then the option price is the expected payoff discounted to time zero, which is this formula here. So far this is just all the standard equations which you'll see in quantitative finance. So we can do exactly the same thing using a quantum walk model instead of a classical random walk model. So we just take the same approach, and you're going to end up with instead of having something that looks like a sort of a rather flattish normal distribution for our stock prices, we're going to end up with a classical with a quantum walk which has these distinct peaks on either side. So in the quantum walk, the distribution depends on the initial condition. So if you start with a balanced initial condition, then you end up with a balanced distribution. We can also skew it a little bit, which I've done here to introduce a small degree of bias to reflect the optimism on the part of the buyer. So basically, this buyer is looking at this asset price into the future, and they're thinking there's kind of two main possibilities. One is that it's going to grow at a certain sort of a linear rate, like several percent a year or whatever into the future, but that's also balanced with the idea that it can also go down by a similar amount. So this is our subjective impression of asset price evolution. On the other hand, there's this kind of more objective view, which is based more on the way that asset prices actually do tend to behave over time, which sort of says they're going to be grouped more with a kind of expectation of no change and a small chance of extreme change on either side. Okay, so now we've got these two different models. So we can think of one of them, the quantum walk model is going to be, because it's more subjective, let's say that this is representing the viewpoint of the buyer, and we're going to use the objective model as to represent the viewpoint of the seller. And the reason for this is that sellers are people who do this is how they kind of make their money, really, most of the time. And so they're going to have a more objective view, which is going to be based on market data. You can think of a kind of decoherence coming in, all this information coming in. It's going to kind of collapse it back down to a classical model. But buyers are going to be influenced a bit more by, if you think of someone who's buying an option in an asset, is usually because they have some position that's going to go up or down by a certain amount. And so if we follow the sort of the same procedure to calculate so we've got these two different pictures of stocks, asset prices evolving in the future. So for either of them, we can calculate what would be the fair option price. And we find that, so for the classical model, we get our classical thing, which is rather like the Black-Scholes model. But the quantum one in blue here is the most noticeable difference really is right here for strike prices which are close to 1, normalized strike price. So what this means is that For these prices, the quantum model is saying the price should be higher, and therefore the consensus model, which is the consensus price, which is shown by this dashed line, is going to be appear to be rather a better deal, and so you would expect more interest in this. And a good thing about these, so we're using our quantum model of supply and demand to get this dashed line. So it's a kind of a compromise between the buyer and the seller. But a good thing about the quantum models, because it's based on a propensity, we can use this to estimate we're not going to assume the market kind of clears or something like that. We're going to say we're going to be able to use that to estimate the volume of transactions at different prices. So starting with the implied volatility curve for the consensus model, we have something that looks like this, and we can do a surface if we want, where we do the same thing. I'm stretching out for expiration dates going out to 1 year, and we get this volatility surface, which is rather reminiscent of the kind of thing that you see in the empirical data. So you get a kind of a skew and a bit of a volatility smile as well appearing. And then what's interesting is when we look at the volume data for the same thing. So this is a volume surface, and what you see is it's quite strongly peaked, as we would expect for strike prices close to 1. And this kind of spreads out in time, but with the expiration date. But this agrees quite well with actual empirical data for option prices. So for example, there was a study and they found the normalized strike price was very close to 1 with a standard deviation, which is in line with what we're saying. So this quantum model shows that it incorporates a bunch of things. It incorporates a subjective model of human cognition, which can incorporate various quantum effects such as interference and so on. But perhaps most importantly, from the modeling point of view, it gives us a sense of the propensity, the probability of transactions, and therefore the volume. And finally, from a purely technical standpoint, a big advantage of the quantum walk model is that it is native to a quantum device. So it can be run very fast on a quantum computer or anything that can perform a quantum walk.